Hello, I'm Raul Elizalde with a quick take on the markets. The most pressing issue for the market until a few days ago was Greece, which was facing very serious fiscal and solvency problems. In the last few days, though, the Eurozone seems to have contained the problem, so it does not seem that it has the potential to affect the market, at least for now. And this happened because the Eurozone seems to have learned a thing or two from the Bear Stearns and Lehman Brothers troubles of 2008. Mostly that you cannot leave problems to fester for too long, or you run the risk that they can get out of control. So with that major problem contained, we now turn our attention back to the US, where things seem to be going rather well. The employment picture has improved quite a bit in the last few months. Retail sales have come in quite strong. Industrial production rebounded to about where it was before the crisis, and so on. Now there is another indicator that also seems to be pointing in the right direction, and that indicator is the difference between long-term interest rates and short-term interest rates, or what economists call the slope of the yield curve. Now this might seem a bit of an odd statistical measure, but it is actually very useful. Economists have used it in the past to forecast economic activity with quite a bit of success. What this measure is saying right now is that the economy and the US stock market seem to be on pretty firm ground. The way it works is this. When the market thinks that the economy will pick up, it expects higher inflation in the future, and therefore long-term rates turn much higher than short-term rates. Even without inflation, when the economy picks up, people and businesses demand more credit, so they push the difference between long-term rates and short-term rates up. And because of the expectation of a stronger economy, stock prices go up as well. Now you can completely reverse the argument. When the market thinks that the economy will go down, the difference between long-term rates and short-term rates becomes much smaller and stock prices decline. Does this work? Well, yes, actually it has. In the past 20 years or so, this measure has been fairly accurate. In 1992, for example, the yield curve was quite steep, and after that, the stock market had a tremendous rally that lasted several years. In 2000, the yield curve flattened out quite a bit, and the bear market took hold for about 3 years after that. In 2003, the yield curve was quite steep again, and we had a bull market until 2007. And in 2007, the yield curve was quite flat, and the market tumbled in 2008 and 2009. Now, what is the yield curve doing right now? Well, the difference between 10-year and 1-year interest rates is at a very high level. So that would indicate that the stock market and the economy are firmly in an expansion mode. This is by no means a sure thing, but in the last 20 years or so, the yield curve has done a good job at forecasting stocks. If that is the case, then the US economic expansion and the bull market that we have right now may have a lot more to go. A stronger economy could also help reducing the big deficits that the US and other nations have been building up, trying to keep the world from sinking. It might very well be that all the fiscal and monetary stimulus packages that we have seen in the last few months may have done the job. Only time will tell if that is the case. For more information, please visit us at www.pathfinancial.net. I'm Raul Elizalde. Thanks for watching.